I am Freda Brown, EA, Enrolled Agent, CDFA, Certified Divorce Financial Analyst with Drennan Financial Services. When going through a divorce, retirement assets are on the table for the division of property. Basically, there are 401ks, IRAs, 403bs, defined benefit plans, government pensions, and annuities. 401ks and defined benefit plans generally fall under the category of qualified plans covered by IRSA, the Employee Retirement Income Security Act of 1974. Qualified plans that are divided through divorce must be done through a legal document called a QDRO, Qualified Domestic Relations Order. Once this order is approved by the court and executed by the plan administrators, it is permanent. Therefore, it is important to get it right. There are tax consequences. Today, I'm going to talk about the tax consequences of dividing the 401k. Once the divorcing couple has agreed to the amount to be divided, there are options. Let's use an example of John and Mary. There is $250,000 in John's 401k. They have agreed to split it 50-50. Therefore, they would be each entitled to $125,000. If they both want to keep the account in a retirement vehicle, Mary would need to establish an IRA, and her $125,000 would be transferred out of John's account and directly rolled into Mary's account. This would be a property settlement, and at that point in time has no tax consequences. When Mary starts withdrawing money from her account, she would include what she has withdrawn in that year as income on her tax return. If Mary is not yet 59 and a half years old, she will also be subject to a 10% early withdrawal penalty. Now let's say Mary needs $50,000 to pay her lawyers and credit cards. If she waits to withdraw that money after it has been transferred into her IRA, and assuming that she is in a 15% tax bracket, she would owe $12,500. That's 15% income and 10% penalty in federal taxes, plus state taxes. And in Massachusetts, that would be $2,650, for a total of $15,150 in tax on a $50,000 withdrawal. She could have this withheld from the $50,000 and receive $34,850 to pay her bills. There is a better way. And at the time of the transfer, written in the QDRO, is the amount to be distributed immediately plus the amount to be transferred. When this happens, Mary is allowed an exception to the 10% penalty. And in this scenario, she saves $5,000 in taxes. Before you request any withdrawal from a 401k or an IRA, it is important to check with your tax advisor. You need to plan to have enough withheld so come tax time, you will not have an unexpected balance due.